What's up, founders? Welcome back to the show. I'm your host, Chris. Today we have very special guest, Ron. He told me not to call him a VC. So I got to ask you this, Ron. Like, what would you label yourself now?
Oh, that's a really good question. I've been a 0 to 1 entrepreneur 10 times over the last 41 years. So I am a serial entrepreneur for sure. I've been an investor for 26 years. This is my fourth accelerator, but the first three were venture studio. Today, there's a term venture studio, meaning our capital, our ideas, and we found the founders to run them, as opposed to founders coming in the door with their ideas and helping them get funded. So today I devote myself at Venture Mechanics to being in between, in the middle of the ecosystem. So we're helping founders to connect, to get their story right and then to connect to the right VCs. But that's typically like a 6-month process before they even float a term sheet. And for the VCs, we're helping them get extremely high quality deals that are fully prepared when they get them. Right, so it's a very different approach from the 90-day Techstars, Y Combinator model, which I think is obsolete at this point. And I thought it was obsolete when I participated in a whole bunch of them over the years, because their concept of sprinkling you for 90 days, you're there and you get sprinkled with mentor meetings,
Really
sprinkled with
fast.
investor meetings, and then you're out. And when I opened Venture Mechanics 2 years ago, I saw all these business plans were like, we've done 4 accelerators and we've already applied to 2 more. Like all of a sudden it became a thing that to be a startup CEO, you have to be good at applying to accelerators. And the figure, believe it or not, there's 200 accelerators in the country, 1.6 million applications a year. Right? It's like, that is not how you get funded. And the average company that goes through one of those accelerators that does get funded, gets funded in 3 years.
See, because that's what I was thinking is what I wanted to talk to you about is how the founders can get funded, starting with how they find the VCs, because we know LinkedIn doesn't work.
So before you find the VCs, let's talk about the statistics, the cold, hard reality. 2/3 of 1% of startups get funded. Of those that get a pre-seed round, 60% will not make it to a seed round. 90% will not make it to a Series A, to a priced round, okay? Of those that make it through a priced round, 25% will return any capital to investors, including negative returns, right? So you have to fly through the eye of the needle.
Yeah.
Right?
For y'all listening, those numbers are very small.
Those numbers are very, very small, and I repeat this many times a day to founders, and I try to help them understand that, especially at a time like this, there's always a race to quality, right? It's an economic cycle. We're in the worst economic cycle right now that I've ever seen in 41 years of raising venture capital. Absolutely the worst. You know, you had the crimes of VC investing during COVID came back as negative returns on the asset class for 2-3 years when the stock market was returning 30%. And so that's what we went into the Trump administration with. And so now with DOGE impacting healthcare, climate tech, climate tech, ed tech are completely destroyed right now. So VCs that have active portfolios in those areas or have companies impacted by tariffs, they're in damage control mode.
That's
right?
a good
They're
one.
literally sitting on record high amounts of cash because they're holding on to the cash because the companies that they funded before, they need to get another round. If they can't get that other round, they have to decide, keep it or kill it. You know, which companies are they going to keep alive with the money that they have? So they're not deploying new cash, new capital at this point to a higher level than I've ever seen. You know, and I lived through the PC boom and bust, the market crash of '87, even the earthquake in '89. .bomb and 9/11 and the mortgage crisis and COVID and all, you know, every economy recovers, but at times like this, there's a race to quality. And so to win, you have to take the time to really, really, really do your customer discovery, do your exit strategy, pull together a team with relevant industry experience, pull together a team with actual experience of doing 0 to 1 startups before. right? Like getting a bunch of Microsoft and Google luminaries to do a startup is the best way to blow your money, because if they have no experience in the industry they're launching
It's
into,
pointless.
and they have no experience, like these skills are not transferable from a Fortune 500 to a startup, then they're kidding themselves, and they're not going to get funded, but they'll spend a lot of time. The other thing that founders don't understand is there's 3,500 VCs in this country. You know how many venture rounds happen every year?
Very few.
Between 2,000 and 4,500. This year will be the lowest in many years, right? So that's an average of one check per VC per year. And active funds that have capital, the average VC is doing one, maybe two deals a year, but having 300 meetings with founders.
I think part of what throws founders off is if you go on Twitter or LinkedIn or some of the social platforms, you'll see some of these VCs talking about the deals they've done. I saw a guy on my way here who was like, we just sent out a check for $5 million. We did 3 other ones this month and we're doing 5 more. Send me a DM. I think that kind of messes up the perception of founders as they see those kind of VCs that are active socially. And they think, oh, that's what VCs are doing. And they don't realize that a majority don't do that.
I don't know real VCs that do that. I know there are a lot of SPVs within SPVs where they're claiming very large deal flow and a very high quantity of deal flow, but then that's low quality because a typical VC. So, if you ask ChatGPT, it always pulls up Andreessen Horowitz because they published the data. They had 3,000 investor meetings or founder meetings in a year, 3,000. And they got to investment committee, not investment, just they got to the investment committee with 20 of them in a year. And that's one of the biggest funds around, right? So
that is daunting.
Your job as a founder, you don't understand, is to edutain these VCs, right? They want to be experts on everything. They never want to pass anybody by. And I don't want to say they categorically, because quite honestly, the best VCs don't put out a shingle. They don't go to events. They don't want 1 million emails coming at them every year. Usually it's the newer VCs and what I call cosplay VCs.
that are more loud.
Never had an operating company and raised money on their own before. They've never been a VC, but now they got a bunch of friends put together $5 million and they're VCs, right? They'll do that. They'll do that high publicity thing. They don't want to miss a single business plan. They want to see them all. But the experienced VCs, when I ask them, how come you never judge at events, speak on panels, it's like, listen, we get our deal flow from other VCs who've known us for 30 years. We don't need to do that stuff. We rarely do that stuff. They're new VCs, and we went from 800 to 3,500 VCs practically overnight when all these you can take a 16-week class and you too can be a VC. Cobble together $3 million and you can call yourself a
All
VC.
right, Ron, you can't judge me because I'm planning on taking that class because I want to learn.
It's only 16 weeks. It's great.
See, but I think more founders should take those kind of classes to at least learn the foundations of it, right?
That's true. Nobody teaches it except us. We do teach it as part of our workshop on Is My Startup Venture Fundable? A third of the class is how does venture capital work?
Yes.
And they have no clue. They don't understand how VCs raise money.
Yes.
They don't understand internal rate of return and mark to market on their current portfolio and how they, invest their capital very quickly relative to the length of the fund, but they are raising their next fund before any liquidity events happen. So they need the founder to go get a step-up round so they can say, hey, look, on paper, we had a 200% return. We're brilliant. Give us more money. Obviously can't wait 9 years to raise the next round for the average exit. Founders need to understand that VCs take meetings for a living. A lot of VCs. VCs that you see in social media, they're taking at least 300 founder meetings a year. Okay, that's 300 individual founders, right? To write 1 or 2 checks. And so if you go out there, as most do, thinking, oh, I got a call from a VC. I'm funded. Open the champagne. Wrong. You got a meeting with a VC. And honestly, early stage companies, which is where I specialize, and pre-seed and seed, maybe early Series A, there's nothing for the VCs to go on except knowing the founder, right?
In that story and the personality, the connection, right?
Well, they don't have any facts yet. It's all known unknowns. We don't know your customer acquisition costs. We don't know your lifetime value. Your pre-MVP, pre-revenue in a pre-seed round. What they want to do is they get to meet you and build a relationship. And this is why, one of the reasons I tell founders, never, ever, ever put an NDA in front of a VC. Like, you're not at the first meeting or even the second meeting. It's like, oh, let's start from a place of distrust. And my formula, my business plan is so weak, my IP is so weak that I have to have you sign an NDA, because if you merely heard about it, you could run off and compete with me. It just shows great naivete, but it destroys the trust that you need to start to develop. So the first thing a founder needs to understand about raising VC is you got to get to know them before you sit down and throw a term sheet in front of them. If you throw a term sheet, statistically, if you meet a VC, go in, do a pitch, throw a term sheet in front of them, unless you already got like some amazing investors that have already come in and they're fast movers at the end of the round, chances are they're going to say no, and they'll give you a lot of reasons. But at the end of the day, the reason VCs like working with us more than anything else, what we hear back, is that they get a chance to meet the founder 6 months before they get that term sheet in front of them. And maybe they meet them again in 2 months. Maybe they come here for a venture competition. They see them pitch again. Very often they'll have seen them 2 or 3 times at pitch events. They've met with them. By the time the founder's ready, they have seen how they operate. They have seen how they recruit management. They have seen how they pivot. They have seen how they close strategic partnerships. They have something to go on.
More cachet.
Yes, and hopefully by then they've also done a ton of customer discovery. That's super essential. You just can't get by anymore without doing a lot of customer discovery. That takes months to do properly. And so, by the time you're actually ready to put a term sheet out, then you can move fast. If you got a clean due diligence locker, you have done your exit strategy, you have done your go-to-market strategy, you have built a robust budget model, you have a robust advisory board. You may still be only 2 founders, but you look like a big company because you brought on these mentors, advisors, board members, whatever, to plus up your team with industry experience and startup experience. Then you have a chance. But that's not what people around here do. Right?
It's a whole
95% of the
different
time, I'm a coder. I don't value my time at night. So I'm just going to write the product. I'm going to show it to people, and they're going to buy it. And then, they don't buy it, or they don't raise capital. And they kind of skipped the whole process of figuring out who your real customer is, how much are they going to be willing to pay for something. And you should do those things before you start building. But 95% of the time around here, it's a software company. 95% of the time they have not done those things. They move very fast, and guess what? So can everybody else. So AI, vibe coding, you can be live. I've had people come in here and say, "Oh, we just launched a company 3 weeks ago. We're ready to raise capital." Well, you mean you built a prototype in 3 weeks, but you couldn't possibly have done any customer discovery interviews. Like, you couldn't possibly have built a budget model. You couldn't possibly have figured out your exit strategy. You couldn't possibly have done these 50 things that have to get done before you get out in front of investors. So that's the longest, hardest way to raise money. They get feedback from the first investor. They go back and rewrite their whole product, rewrite the business plan. That guy could have been wrong, And every time they go meet with another investor, they run back, tell the engineers, "Oh, we got to rebuild it.
It's something else.
Thought it should be something else," or an advisor, or somebody else in there. You got customers, you got investors, you got mentors, advisors, you got your lawyer, you got your spouse, you got your kids, even your coworkers, co-founders. Giving you conflicting feedback. By the time I meet an entrepreneur, they're usually paralyzed. They don't know what to model. They don't know what their first beachhead should be. They've been told they should be B2B or B2C. They should price this way or that way.
And it changes a lot, because if you're always talking to different people, and I think that's what happens with the investment advice, because if you go anywhere on social, the loudest is kind of YC. Like, Y Combinator is so loud when it comes to investment raising. And I think every founder hears that and they see it all the time. So they think that's the only path to take.
Yeah. And I see founders posting on LinkedIn, "Oh, we applied 6 times. We finally got in. We're done. We're funded." Like, okay. Again, making a career out of applying to accelerators is not an efficient way to do it. But the problem I have, always had with these programs, is if I'm a mentor in the program and I don't know what the other mentors are teaching or who they are, I could be giving redundant advice at best. conflicting advice at worst. But I know, as a 10-time CEO, I'm damn well not giving them complete advice, right? There is no quarterback who is making sure that this founder gets trained on how to run a venture scale company. That's a lot of skills. And if you got an MIT PhD in AI, good on you. But what do you know about taxes and patents and all the other things you need to know to be the CEO of a startup company that isn't necessarily venture capital backed, but venture scale? Big distinction there. We don't only do venture capital backed companies, we do venture scale. Regardless of where the capital comes from, there are skill sets that are needed to run a fast company like that. And these other programs, there's no possible way on God's green earth, I don't care how many accelerators you did for 90 days, that you got fully trained.
Yeah, and that's one thing I wanted to ask you about is, do you think that it would be better for some of these founders to then hire a CEO to run the company and kind of get out the way because they don't know those things? Or would it be better for them to kind of learn as much as they can on their own?
This is my standard advice to founders, first-time founders, is join somebody else's team, preferably some experienced founders. Get on their team once, twice, 3 times. Learn from the inside the ropes of running a startup, of doing fundraising, of hiring people who are mostly there for the stock, not the salary, of all the things that you need to learn. If you can learn it on somebody else's nickel, essentially, you're not going to earn it with your tuition at a college, right? This is stuff they don't, even the entrepreneurship programs are taught by people. Frankly, I get brought in as guest instructors.
They're not entrepreneurs.
They're academics. Like they read books about.
And no disrespect to them. No disrespect. But they're not.
Some of my favorite people, but no, they've never done it themselves. That's why they bring in guys like me to talk to the students. And they say, look, get as much experience as you can. I was fortunate to work for CEOs from my very first job. In Silicon Valley as a young guy, I reported to CEOs, every company, until I did my own company. And then I've never done anything else but start companies and be the CEO. So I was really fortunate. I had a tremendous tutelage. It was just, pure luck. Right place, right time, and terrific. So I saw what it was like from, joining a company where I reported to the CEO that they had just gone public before I joined the company, right? In the PC boom days in 1983. To joining a company when I was employee number 6 and we went public. I got to be on the floor of the New York Stock Exchange when that company went public.
I'm going to find that picture and put it up right here. I'm going to put it up.
Yeah. So, getting tutelage from mentors. Techstars kind of changed the meaning of the word mentor. We now accept mentors as people who work with accelerators and incubators to help startup companies. But a mentor is actually originally somebody who helps you with your career. That's a mentor, a career mentor, right? So it's kind of morphed in meaning. Yeah. And we call all the people around here mentors that are helping startups. But, a true mentor, if you're going to do startups, is somebody who's done a bunch, right? And that can be effectively both in one, right? If you want your career to be building startup companies, which I wish everybody would, that's who I am, and not too many people are, 1% of the population are really destined for that, right? It's great. At venture scale, at least, obviously, there's millions of small business owners, and small businesses are the driver of the economy. There's nothing wrong with building a sustainable business that does good in the world. And anybody who's considering doing venture scale should read my article on the Venture Mechanics blog about is my startup venture scale, and read all the reasons why you shouldn't. And if you're still reading, then here are the reasons why people still do it anyway, despite these ridiculously bad odds, right, that we talked about.
Because I think the way you put the numbers out there in the beginning, that's going to deter a lot of founders who are like, I need to raise. And then I think a lot of them hear that, and then they want to take a different path of I don't need to raise, now I want to bootstrap. And I don't necessarily think that's bad, but from your perspective...
It's a lot easier to do every generation. When the cloud first came out, I had one of those .coms in 1999. It cost $1 million to launch this company. It would have been $10 million before the cloud, right? So now it's like $10,000. You're live with an AI-built website in no time. The problem is so is everybody else. But let me get back to what I was saying before. My advice to founders: always get some experience about what it's like living in a startup. Make sure it's your it's your jam. Honestly, you may be much more comfortable at a Microsoft with a great benefits program and never having to worry about missing your paycheck, except, how many people got laid off from Microsoft last year? There's no guarantees in corporate America anymore either, but, better risk profile, right? Like, is this, do you eat risk for breakfast? Is this what you want to do? Because there are days when you want to crawl under your desk in the fetal position, and there are days where you're dancing on your desks, right? And the cadence of that is every 5 minutes.
Oh,
You're going through that startup life, right? It's like, oh shit, oh wow. Right?
Well, I want to give you guys perspective. Before we started, I asked Ron if he works on Sundays. He said he works every day. So that's what you're signing up for, like to work every day.
I miss all the family vacations. I try to catch one a year. But most people also look at me and guess I'm 45. I'm 61. And I believe it's because I surround myself with incredibly optimistic people all day, young people with great ideas, and it makes me jump out of bed every day. And if you're not jumping out of bed to go to work, you should shoot yourself or get another job. Like, well, that's called hell to me, to not be extremely eager to get out of bed and go to work every day. I know you enjoy what you do. I do meet a lot of people who've really kind of checked their soul in at the door, but they're getting $400,000 a year at Microsoft, and nothing against Microsoft or Google, but it's very comfortable. And so you do first have to ask yourself, do I want to do this? Okay, if I want to do this, let me get some experience under somebody else's tutelage first. Then when you start your company, recognize that the average CEO that does get an exit is 3.5 startups. For me, it was my third startup. First 2 folded. 7 years of my life and all my credit card debt and I was left with and all that. And then, next is 0 to 100 million in 18 months. Holy shit, right? Like that's, sorry, am I allowed to cuss on this podcast?
Yes. You asked after you say it?
Yeah. So that was a suspension of disbelief. That was .com. The next few exit experiences were grounded, realistic, and felt a lot better. I never felt great about the .com win. It was insane. 0 to exit in 18 months is crazy enough. Nine figures. No, it felt like suspension of disbelief, suspension of physics and time, and and we're going through that right now. Only the valuation extremes that we're going through right now, the acceleration of valuations on AI companies is way faster than .com. So we all know that there's going to be an explosion, a bubble burst. If you're old enough, you've seen this movie, right? But younger people haven't seen the movie. A lot of people have short memories, forget. My concern, Chris, is I love the city of Seattle and our resilience and how we got through COVID and all that. We always had a strong middle market economy. After COVID, the knees got cut out, right? All these startups that failed during COVID, well, they didn't enter into the food chain to get acquired and to become middle market companies. Innovation died. And now we just did it again with this AI bubble that comes. And depending on the list you look at, we're the second or third biggest city in AI investments. And we have such a high concentration in AI. This is why we love hardware companies. We love aerospace companies. We love consumer packaged goods. Today, we had a conclave for a better for you energy drink. That's meat and potatoes. You're still going to eat and drink. You may not be using the same AI platform a year from now that you're using today, right?
Because there's so many.
There's so many, and the problem is it's so easy to start one, right? But if you think about the fact that the average CEO who exits, the average founder who gets an exits 3.5 startups in, your first round and your second round are probably practice rounds, right? And so get real. And it is definitely, I was guilty of this, right? When I did my first startup, I wrapped my entire identity around that company. I worked every waking minute on that company. And when it ultimately failed 3.5 years later, I was crushed, right? I eventually learned the key to being a serial entrepreneur is that, if the grandfather dies, everybody's in grief, right? But then a new baby is born. And everybody's happy again. And you love the memory of grandfather, but it no longer brings you down, right? And it's the same thing I have learned over time. I grieve after every company that has failed, but the only thing that replaces that grief is starting a new one.
Just keep going.
And keep going. And it's the same thing when I'm in a position of helping startups. And I know that not all of them are going to make it, right? But there's always another one coming in at 3:00 that has the next great new concept. But at a time like this, there's just a huge amount of volatility and an extremely difficult venture capital climate. More than ever, I try to encourage founders to set realistic expectations. You can go the hard way, and it's going to take you longer, and you probably won't succeed. Of going to events, meeting every VC, thinking they're all cut from the same cloth, and if you got a meeting, you're in. Guess what? You just educated that VC on your industry and your startup. Congratulations, that's great, but they were never into you. They're just not that into you. Most of the time, when they take meetings, you got to understand it. If they don't have capital to deploy, they're still taking meetings because they have to show the LPs they're trying to recruit into their next fund. Look at my deal flow. So they never stop, and they rarely ever tell founders candidly that they can't even invest, but they are happy to take meeting after meeting.
So if there's something I want founders to take from this, what I'm hearing is that don't get too excited about a VC meeting. You getting a meeting doesn't really mean anything.
Getting a girl to accept the drink that you bought her at the bar does not mean that she's going to give you 20 grandchildren. Okay, yeah. This is you're jumping way too far down the road. But I see it all the time, and then I see those same founders come back. We had one where there were a couple of really high-level VPs at Amazon, and they're like, we don't need your help. We get VC meetings, no problem. Great. 6 months later, they've taken the startup off their LinkedIn's, right? So I ping the guy, and I say, hey, what's going on with your startup? Oh, well, we went and started another startup in stealth to make money to keep funding the one that we ran out of money on because we didn't raise money in time. And I'm like, you could have been funded by now if you had let us help you. But if you're so arrogant because you think that it's so easy for you to get meetings, well, sure, who wouldn't want to meet these senior VPs from Amazon? Every VC I know would want to meet them, right? And this is great G2, if nothing else. And maybe they have a really cool company. But they spent all their time. I see founder after founder after founder, just every day. I see founders that spend all their time flying to New York, flying to San Francisco. They had a connection. They met a VC. The VC says, "Sure, come on in and see us." And they think in their mind, "Come on in and see us," is we would like to fund you. It is so far from we would like to fund you. But if you're willing to buy a plane ticket and take 2 days out of your life and fly to New York to meet these guys, the odds of that actually turning into a transaction are a fraction of 1%. So there's a right way and the wrong way to do it. And the right way, people don't like hearing this. They want to go fast.
That was going to be one of my questions. We talked a lot about the wrong. Let's talk about the right way, because we know spamming LinkedIn isn't it. Being excited for every VC meeting isn't it. It's just not. It's not helpful. So what's that path that the founder can take to really get the result?
So the first thing is to make sure that you are the first investor in the company, right? And you do have a burn rate, and you only have so many spare hours in the day to work on things. So you want to work on something obviously that's going to be productive. And sometimes you work on a business plan for 3 months and then hang it up. That's an awesome outcome. You only spend 3 months to figure out that it's not going to hunt. That's an awesome outcome. What's bad is you spend 3 years. I see these founders all the time. Already did a second mortgage on your house, already got divorced. Okay, that's a bad outcome. So doing the right thing is so important to do. This has changed in the last 5 years. It's no longer acceptable to just build a product, take it out there, hope people buy it, hope they eat the dog food, and go to VCs and say, oh, we already designed it and built it and put it in production. First, you got to do customer discovery. That's our most popular workshop here. At the very least, read the mom test. It's a simple book, but be rigorous and document. Because the VCs want to know now that they're not the gambler who's going, well, he seems to have a great idea. Let's see if the market eats it. That age of VC is over.
Okay, I want to ask you this. So let's get an example of that specific, the like you said, the mom test of going to talk to customers.
It's really, yeah, it's very simple to boil down.
Is it having like a newsletter of 1,000 people on a wait
No.
list? Is it
No, no,
doing
no, no, no. First of all,
interviews?
you cannot outsource this. The founder has to do it. You cannot do this with a survey. You got to meet face to face. Worst case, Zoom meeting, but you got to meet face to face with people, read body language, and ask them, okay, let's talk about this. How do you hire people today? What do you like about it? What do you not like about it? You ask that question of anybody who in today's day and age, they're trying to hire people when 1,000 people apply for every job, and all these bots interviewing bots and all the craziness. AI back and forth, like the worst hit sector where AI actually made things worse instead better. The only sector I can think of where AI made things worse rather than better. So you need to sit down with folks and ask them, real customers, first figure out your personas. And if you're in a two-sided marketplace, you have personas on both sides, right? Like you have to figure out all the personas, and then literally, unless you start getting extremely consistent results, that are statistically significant, you got to interview typically 100 people. And you got to ask them, okay, what do you not like about it? What would make you switch from the current method? Because you're always coming as a replacement for something. It's very rare instances, there are, but they're rare where you're like such a new thing. Nobody's ever done it before. Okay. But even the iPhone was replacing what I used to carry around, like
Was it the BlackBerry?
Filoflex. No, before that was even just this 3-ring binder with your contacts and your calendar and all that. You went everywhere with it, and if you lost it, you were dead, right? Like no cloud backup.
Yes.
So you're always replacing something. You're always replacing something that they're doing today. Guy Kawasaki used to say, and I truly believe it, it has to be 10 times better to get people to switch. Incremental differences? Nah, I'd rather, there's a lot of inertia to changing behavior. And so if it's 10 times better, well, how much are you going to be willing to pay for something that's 10 times better? And you're going to switch, and you're going to tell everybody that you have switched and now you're on this platform. So that's in software, right? Hardware is different, aerospace is different, moonshots are different, deep tech and drones and all that. They're all different sectors. So it's really hard to give just generic advice on this stuff. Consumer packaged goods is wildly different.
But I think the basic concept of talk to your ideal customer can kind of, at some level, work for everybody, right?
Yeah. But like in CPG, if you're creating a new beer, there's no substitute for tasting the mouthfeel, tasting the flavor, and all that, right? So at some point, you have to work in the kitchen, create a recipe, and put it in front of people and see what they think. It's very different from developing software, where there's a million ways you can develop it, but you got to find out what are the features that people really need. What are they really going to pay for? What's a nice to have? What's a must have? And we have a saying in this line of work: is it a vitamin or a painkiller? If it's a painkiller, I have a real pain and I'm willing to pay to make that pain go away. If it's a vitamin, I can take it or leave it. It's not really going to make me change my behavior. It could just be competing on price. But yeah, this is convenient. I like buying at the store. It's a little more expensive. My wife and I both live in the same house. We're both professionals. She's a physician. And we both have different attitudes. She likes to go to QFC because it's right by the house and pay twice as much as I pay at Amazon Fresh, but it's one more exit down the road. And I like the value and the quality and the tech and all that stuff. I love the Amazon Fresh. I'm a huge Amazon fan. I'm a Seattleite. Actually, really like the innovation compared to the QFC, right? Which is just
it's much more convenient, honestly.
I find it much more convenient, but she won't go in there. Okay, I can't explain it, but that is their consumer, and I am Amazon Fresh's consumer. We live in the same house. We've been married 27 years. Okay, it doesn't matter. There's different personas, right? So figuring out who's likely to buy your product and then having a ton of interviews with them, documenting it, right? Because when you document it, you can actually statistically add it up. And almost every time I hear from founders that they actually took our course, went and did it. And then came back and was like, wow, we were building the wrong thing. We had no idea the real opportunity was over here. And so once we started building that thing, guess what? You never stop doing customer discovery. You need to keep that process after you've launched your company, because market conditions change, the reasons people buy your products change. You got to get good at it. And it really ought to be, I believe it should be the founder to do it. But you asked a question I did not yet answer, which is, when should you be the founder and when should you be the CEO? This is one of the most important questions, because people get wrapped around an axle on this. They think that, how can I not be the CEO of my own company? I have founded this company.
You're married to that idea and letting it go sounds crazy.
So take it from someone who has, had to go through the growth phases and eventually be tapped on the shoulder by the board and say, it's time for you to go. Right? The CEO, Bill Gates' dad, was a very experienced business lawyer, right? I'm sure he told Bill, don't be the CEO. How many CEOs has Microsoft been through? You're not as old as I am. I could tell you, before the big names, before Steve Ballmer, right, there were a bunch. And, the founder is always a founder. Nobody ever takes that title away from you. You are the flag bearer. You're the reason people are joining the company. It's your vision. It's the corporate culture you create. That doesn't change. The CEO is a very temporary position in most cases. Companies go through CEOs like crazy. And guess what? 9/11, big spike in CEO firings, right? We got to show shareholders we're doing something. COVID, big spike. Like, all these cycles also come with CEO firings as boards feel like, oh, we have to do something about this, so we'll fire the CEO. It is a kind of a defense mechanism, shareholder defense, yeah. But the reality is it's the hot seat. And the moment you realize that that is the hot seat, you don't want to be there. You want to be on the board as the founder, as the chairman, and being there every time, deciding who's going to be the CEO. Now, why would you want to get a CEO in the beginning? It's not prescribed every single time, but about half the companies that we work with, we do say to the founders, listen, if we can find somebody who has raised money in this industry before and returned it to investors and is willing to write a check coming in, ideally, as well, compare that. I've never done a startup. I'm here in front of you with my idea. Give me money. Or versus, hi, I've done startup. I've returned money to investors. I found this incredible founder, and I decided I believe in this so much. I'm writing a check, and I'm joining a CEO, and I'm not taking that next Fortune 50 job. I'm going to be right here running this company. Which strategy do you think is going to raise money faster?
That experience sounds a lot better. It does.
And eventually, that person realizes they're an interim CEO. All CEOs are interim. Just get that through your head. Like, unless you're a 100% shareholder in your company, all CEOs are interim. Pretty much all positions in the company, except founder, are interim, right? And you look at the founding team of 5, by the time a company goes public, only 1 is still there, right? That's a statistic as well. IPOs, of course, are extremely rare anymore, but we only have 4,000 public companies. Most of the time you're acquired, but even in the acquisition, now we'll keep that one and that one. Those can go away with a severance package, when they acquire the company. So, nothing's forever. But one thing is for sure, if you want to be the CEO of your own company, and you've never been one, the odds of you being Fred Smith at FedEx, right, who's now, I think, chairman emeritus or something, but he was the founder, he was the first CEO, he was the CEO all the way through, decades and decades. That's so rare.
I don't think founders realize it. That's very rare.
Realize it. They don't realize it, and they wrap up they have a hard time letting go of this concept. The smart ones, and that's why our average founder that we work with is in their 50s. Most accelerators are working with people in their 20s. I like working with older people who go, you know what, I've been through life. I've had a few experiences, and not only does the CEO job not sound like fun, because I'd really rather continue to work on product and be in front of customers than to attend benefits meetings and to deal with shareholder reports and all this other kind of stuff. Like, a lot of the CEO job, I've done it for 41 years, is total drudgery.
It doesn't sound interesting at all.
No, it takes you away from the thing that you love. And after a while, you realize, like, wow, I don't get to go to as many conferences. I don't get to interview as many key employees. I'm too busy. I have too many meetings. I'm responding to directors and shareholders. It is not the glorified life of Hollywood depiction. It just isn't, right? And so for a founder, when you look at that list, that article I mentioned on the blog about do I want is my startup venture scale, and you look at the list of reasons you don't want to do, or you do want to do a startup, one of the reasons people want to do a startup is that you can have an idea in the shower in the morning, and you go to your boss at the startup, and at 3:30 it's being implemented. You can have that same idea at a Google or Microsoft or Meta, and a year later, after many, many meetings and many committees and politics and this and that, they're still not executing it, right? Or if they do, they execute it, and then a strategic shift, and we're killing that. So it's that short loop between you having an idea, being able to talk to a decision maker who says, you know what, great idea, go execute it, and you get the experience of executing it, right? Those are the things that are really cool. When a company gets to a point where, I've been there with 120 employees in 9 cities, and I hated it. I just wanted to be in front of customers. I just want to be working with the engineers and building a better product. I did not want to be in all these meetings with spreadsheets and, health benefit programs. Like the thing I most hated in the world was having to choose a new health benefits plan every year when the rates went up and all those proposals. And, that's not why I started my company, right? Is to do that. So if you think that that's what you love to do, sure, go for it, but I don't know too many founders that take joy in that part. But it starts to kill the joy. And, when that starts to happen to me in one of my companies, it gets too big, I start writing the next business plan, right? It's time for me to exit, let somebody else take control, take over, I'll stay on the board or whatever, or go off, do my next thing. But yeah, unless you've done it before, you don't realize that the CEO job is just not glory. It's all the stress, all the pressure is on you.
I know we started off talking about how to find funding and all of that stuff, but I think the transition into what a CEO actually does is going to be very valuable for founders because most don't want to let that go. They refuse to. That's a big one.
Here's some other basic reality that I go through in our workshops with first-time founders is that the sole function of a board legally is to hire, monitor, and fire the CEO. Everything else is volunteer work. Okay, they may join the audit committee, they may join the compensation committee, they may help you, interview VP candidates, C-suite candidates, all that kind of stuff. There's important stuff that they do, and I mean to diminish it, but the legal function of the board is just that. And the function of the CEO, you have a few key functions. You are the representative for all the common stockholders on the board. That means your employees or anybody who has common stock and your investors, you're representing them. You are setting the strategic direction of the company, right? And I've had founders freak out about that, but I'm setting the strategic direction of the company. Look, it's done in a room with a whiteboard, okay? But ultimately, when it comes to, hey, this team thinks we should do product A, this team thinks we should do product B, the CEO has to make that decision. And if you're the founder and you're so stuck on, the first thing you started to do and you're not accepting of new ideas, you shouldn't be the CEO. If you're just glued to your original conception and can't see with a bigger, more objective lens, more objective lens, right? So that's what, but as time goes on, the saying is, we need to bring a CEO in here who can paint stripes in the parking lot. Okay? Nobody bothered to park their cars. They didn't have time to park their cars nice and even in the parking lot. They just all jammed into the office and did their hacking all day long and then jammed out. And eventually you get to the point where you just can't scale unless you start putting in hiring procedures, operating handbooks.
The behind the scenes stuff you don't even think about when you're the founder. You don't even think about a health plan for your employees. That's not going to cross your mind.
It's always on the VC due diligence checklist. So do you have any contracts with any of your employees? What? No, we were friends. We started this thing together. No, I'm not going to do a contract with my friend. Okay, you're now at a point where you have to do contracts for every single employee. You got to go back, compensate them in exchange for signing an agreement of non-compete, non-invention, non-disclosure kind of agreement that's required of every employee before you get to a price round. Certainly, these kinds of things. If you're an engineer or you're the world's best sales guy, you hate having to do this stuff. It's just it goes so against the grain. Guess what? There are people out there that thrive on it. For every visionary founder, they need the counterbalance of a administrative, detail-oriented manager who, keeps the trains running on time because the founder went off for the weekend, came back on Monday morning, wants to scramble everything up, has a new vision, and the CEO has to decide, okay, what is our strategy? Are we changing our strategy overnight?
It sounds like the CEO of a company, of a startup specifically, is like the designated driver.
Yes, that is a good way to put it. And early on, the founder is the CEO by default. It's really hard to even recruit a CEO when you can't pay anybody. So you get your first funding round, and you're just establishing some known knowns. You start with 0 known knowns, right? It's all known unknowns. And then you start getting some data. What's our cost of goods? What's our cost of customer acquisition? You still don't know your lifetime value until a little more time goes on. But understanding what venture scale is, so here's the funniest thing, right? So you've been to these events where founders come in here and they walk up to me, "Oh, can I sit down with you, Ron, and tell you about my idea?"
I always laugh when I see it across the room.
Right? And I always say the same thing. Well, tell me, is your idea venture scale? That's how I start every conversation. Is your idea venture scale? Because I only do venture scale. Oh, yeah, absolutely. It's venture scale. Oh, great. Define venture scale for me. And then, 9 out of 10 do not know what venture scale means, but they think the words apply, right? And then they take a workshop and they find out, ooh, I had no idea that what I was working on is like a hobby business, lifestyle business, small business, micro enterprise, whatever you want to call it, but it's not venture scale.
And it's not a bad thing. I think sometimes they get upset. They get upset a little bit,
One time I had a guy get really upset. Most of the time they're like, oh, wow, I didn't realize that. Thank you I'm going to go back and learn more. I'm going to take the workshop. I'm going to want to understand what is venture scale. So take a SaaS software company, kind of some simple metrics. Obviously, the market size has to be big enough, but it's got to grow 15 to 30% month over month in revenue. And you can't have a ratio of less than 4 to 1 of the lifetime value of the customer versus the customer acquisition cost. Right? Have you ever done that calculation? No, I don't know how to do that calculation. Well, how do you know that it's a venture scale business if you don't even know how to do the calculation or that you need to do the calculation, right? So there's so much what I call the entrepreneurial seizure, right? I'm going to quit my job, or I've been fired and I can't get a new job. It's been 6 months. I'm going to start my startup. I always wanted to do my startup, right? Okay, that's great. But at that moment in time, you cannot trust yourself. And you are the first investor. You got to recognize you're the first one writing the check. So what would it take to convince you to go for a year without an income? And then you get your pre-seed round, and maybe you get a $50,000 salary. Before you get your seed round, then you're getting to half of where you were at Amazon, right? Oh, you're here for the equity. We don't, you don't throw a lot of money out the window with salaries in a typical pre-seed and seed stage startup company, right? So anyway, understanding what venture scale means and then evaluating your business plan against that. And it's different for different industries, right? I just gave you the example of a SaaS company. And then understanding what VCs want to invest in. The worst advice I ever got was do what you love and the rest will follow. Okay, great. May work for certain careers, but not for doing startups. You have to do what investors love. Just because I loved flying airplanes, 41 years ago, I built an aviation company. And I didn't even get to fly many airplanes. We were making avionics and flight simulators. And I found out that VCs hate investing in aviation. It's the hardest thing in the world to get people to invest in. So I didn't know that. And I had amnesia, and I went and did another one.
My goodness.
And I've been involved with a lot of avionics companies, flight simulator companies over the years. Most of them, like most startups, don't actually make it. Even after $25 million of venture capital, they still not make it. They're a tough industry. But I learned you need to Not necessarily chase the shiny object, because everybody right now is running to create an AI startup before AI VC funds roll up.
Yeah, they're
Okay, let's do the wrap, and then I'll go.
okay. So before we go, what's one last piece of advice you would give to the generic startup founder that's trying to raise capital for their company?
Really simple. If you're married, do not do a startup at the same time. Definitely don't do the same one. That's extremely difficult to get funded for lots of reasons we don't have time to get into. But you should one of you should have a secure job.
Yeah.
or the marital stress goes through the roof, because when it comes down to who's going to stay with the startup, who's going to quit their job and get a real job, because both of them are not getting their funding or revenue or whatever, you don't want to get laid off and do it at the same time. If you're married, of course, a lot of startups are founded by single people. And I realized one time I was 35 years old and I was the only unmarried person in my company, that it's like, maybe I should take a break and actually marry the girl I'm dating next, and start a family. So, that's also kind of an important thing, depending on your age and how long you've been doing it. Maintaining work-life balance is kind of a humorous joke in this racket. Some people do it, and I have to respect that. Some people can really pull that off. I will not ascribe. I will not say that I've been successful at that. Certain points in my life, yes, but oftentimes it's just all you think about is survival the next day, and there's no time for other things, and you miss a lot of the upbringing of your kids and things like that. And by the way, the best time to create a startup is when you just got divorced and you need something else to focus 100% of your thoughts on. Those are some of the best, fastest moving entrepreneurs I've ever met. Right? So anyway, real life interferes with startup life. So like making sure that if you're in a relationship, you're very, very clear about what this means to do this, and where is the line in the sand for you, as including, and the other end of that spectrum is actually sitting down with your spouse and saying, okay, if my ship comes in, what are we going to do with it? And having that conversation before your ship comes in. Often you have no warning that the ship's coming in. Some acquirer comes along and eats you up fast. You never had a chance to talk about that, but I think it adds a lot of motivation to the founder to know, what am I going to do with all that money I make? Way too much, more than I need. What would I do with it? What do my spouse and I, or my family and I, agree in common we are dedicated to? Like what kind of causes? And sometimes you can even leave stock in your estate plan to causes that matter to you, things like that. I do see more cause-driven founders these days, and sometimes they want to take a percentage of all revenue goes to support this cause. If that cause is in alignment with the business, okay, great. Otherwise, investors are going to come to that and say, listen, let me make the ROI and I'll decide what charities I'm putting my money into. Same way as they don't want the federal government necessarily deciding what charities they're going to fund, right? Like leave me, take less tax money from me and let me do that. So founders also have to be careful of that. But I'd say just make sure that this is something you really want to do. Read that blog article. Get real about the downsides and the odds of success, and make sure you're comfortable that you really embrace the idea that even if you fail, you win. You've won incredible skills, experience, and you're better set up for the next time. And you have to go in with that realistic attitude, or if you fail, and odds are you will, you're going to kill yourself, right? Yeah. You don't want to do that. You want to parlay that experience, that energy into the next thing. I'll say one last thing. Sorry, keep going so long. I lost a company one time. I went for a hike in the woods for 5 weeks. Went up to British Columbia, and I'm hiking in the woods, and I'm taking a naturist or naturalist. What do they call it? One's a nudist, and one gives hikes in national parks. Anyway, I'm taking this tour, and she's talking about the nurse log. The nurse log is that tree that falls in the forest, and then the other trees grow out of it, right? And it dawned on me that all the people that got so much training working on that startup. It was startup number 2, and several of them went off to start their own companies. And I realized that this biomatter doesn't just disappear. It becomes nutrients for the next startup. And it may not just be your startup, but other people who worked with you picked up skills, turned around, and created a new company that gives me a thrill. So whenever a company has died, I try to focus on, yeah, but look at how much experience these people picked up and how they're going to parlay that in their careers or their own startups in the future. I've lived long enough, I've done enough companies to see that cycle actually happen every single time, and it gives me a lot more, I'm a lot more okay with the fact that, most of the companies are going to die.
Wow. That is some good insight, man. I like that last one. That was good. Well, Ron, I know you got to run. Thank you for being here, being on the show. Such an amazing guest. A lot of great insight.
Cool. We talked about some fun stuff. Thanks, Chris.